For decades, the majority of wealth in India was locked in physical assets like real estate and gold. But that is slowly changing. Today, more and more money is moving towards equities, mutual funds, and other financial products. And this shift is not temporary, it's structural. Now, as long as people were investing in just one or two assets, things were relatively simple. But as portfolios become more diversified across equity, debt, global assets, and alternative assets, managing money is no longer straightforward. That's where wealth management comes in. Because now the need is not just to invest, but to allocate capital properly, manage risk across cycle, optimize returns, and think about long-term wealth preservation. And this is where India is still very early. Just to give you some numbers, today India's total household financial assets are estimated between 300 to 350 lakh crore. Now this financial asset can easily grow 2 to 3 times in next 10-15 years. That translates to a market of 800 to 1200 lakh crore. Now even if 10 to 15% of this wealth shift to actively managed wealth platform, that translates to a potential opportunity of 100 to 150 lakh crore. And that's exactly where companies like Nuvama Wealth Management comes into picture. Because they are building platforms to capture this shift as more and more Indian investors move from just investing to actually managing wealth in a more structured way. By the way, I've already discussed the wealth management sector in detail in the past, but it's been a while, so I thought of revisiting this space. So in this video, we'll deep dive into Nuvama Wealth business model, growth drivers, financials, and then we'll look at the valuation. Interestingly, due to the slowdown in Indian market, Nuvama Wealth share price has been consolidating since August 24. Today, Nuvama Wealth commands a PE of less than 25, whereas its peers like 361 command a much higher PE of more than 35. Again, the question is, why is there such a stark difference? Is Nuvama that cheap or 361 so expensive? The answer lies in the business model. So we'll try to figure out if Nuvama Wealth is worth exploring for investment at current levels or not. Finally, we'll look at the key risks that you must keep in mind before investing your money. There is one concern a lot of people have for Nuvama, and that's because of share pledging. Nuvama promoters have 62.8% share pledged, and many people think that pledging is a key risk. So we'll discuss that as well. Alright, let's get started. To understand Nuvama Wealth business, you need to look at its 4 distinct business lines. It's very important because it's not a pure play wealth management company as of now. So it operates across wealth management, asset service, and capital market. Now if you look at wealth management business, which is the core business of the company, this is where Nuvama advised the high net worth individual on allocating capital across your equity, debt, structured product, and alternatives. Now the way the company earns here is through distribution commission, where client invest in various products suggested by Nuvama. Also, there is some advisory or management fee on assets under management. The more client assets grow and the more activity happen, the more revenue this segment generates. Now, as far as quality of earning is concerned, wealth management is mostly a recurring and sticky revenue model because wealth management has high switching cost. Once a family has moved their trust, tax planning and entire portfolio to Nuvama, they rarely leave. This creates a highly predictable annuity-like income stream. But of course, there's a cyclical angle where if let's say Nifty drops by 20%, Nuvama AUM will also drop by around 20% and their fee income shrinks proportionally, even if no client leave. But the best part of wealth management vertical is operating leverage. Once Nuvama covers its fixed costs like rent, base salaries, technology, almost every additional rupee of fee income from the rising market or new client drops straight to the bottom line as profit. Because it takes roughly the same number of employees to manage, let's say, 10 lakh crore as it does to manage a 3 lakh crore. Then second vertical is asset management. It's a relatively new vertical where Nuvama creates and manages its own investment products like PMS and AIF. Here the company earns management fee as percentage of asset under management and in some cases performance fee if return cross a certain benchmark. Again, this is a higher quality revenue stream because it is more recurring and linked to long-term AUM growth. Then third is asset service business. This includes your custody, fund administration and platform services for institutional clients like your FPIs and AIFs. Revenues here comes from servicing fee which are typically linked to the size of asset being serviced or the number of transactions. So this business does not depend heavily on market sentiment or investor activity, which makes it more of like a annuity-like business. And finally, the fourth vertical is capital market business. This includes your broking, lending against shares, and investment banking activity like IPO placement. Here, Nuvama earns brokerage income from trading activity, interest income from lending, and fee from capital market transactions like IPOs and deal structuring. Please note that this segment is more cyclical as revenues tend to rise and fall with market activity. Now, this slide gives a quick overview of earning from each business vertical. The numbers are in million USD, but the key is to look at the percentage contribution from each vertical. In FY25, wealth management has highest 49% contribution, followed with capital market at 26%, then asset services 22%. Asset management is still in nascent stages. Now this slide gives a good idea of growth in 9 months of FY26. Since FY26 was a difficult time for capital market due to fall in stock market, capital market segment has degrown 20% year on year. That shows the volatile nature of this vertical. Wealth management, the biggest business, has still grown at 21%. That shows the earning from wealth management is recurring and annuity based. Asset service has grown at 15%. Okay, now that we understand the business model of Nuvama and quality of earning, the next question is, what will actually drive the growth for Nuvama Wealth Management going forward? Let's discuss. So the first and most important driver is growth in AUM. In wealth management, everything starts with asset under management. As more clients comes in and as existing clients allocate more capital, AUM grows. And since a large part of revenue is linked to AUM, this directly translates into higher earning. Now this growth can come from two sources. First is market return and second is net new inflow. Market returns are cyclical but inflows are more structural. Just to give you a sense of AUM growth, if Nuvama manages to add new AUM by let's say 12-13% CAGR rate, which is quite doable, and if AUM itself grows at 12-13% CAGR rate in long term due to market return, which is again a reasonable expectation, in that case the net AUM growth can easily be 25% CAGR. Then second is shift from transaction based to fee based income. Historically, a large part of industry earned through commissions, but over time there's a clear shift towards advisory-led fee-based model. This is important because fee income is more predictable, more stable, and command higher valuation multiple. So as Nuvama increases the share of fee-based AUM, the overall quality of earning improves. Then third driver is expansion in asset management vertical. This is relatively a small part of the business, but it has strong potential. As Nuvama built its own PMS and AIF product, it not only earns management fee, but also performance-linked income. Over time, if the segment scales up, it can significantly improve margins and return ratios. Then fourth driver is operating leverage. This is one of the most powerful levers in the business. A large part of the cost structure like technology, distribution, and base employee cost is already fixed for the company. So as companies' AUM grow, revenue scale much faster than cost. That means margins can expand meaningfully over time. And finally, the biggest tailwind is the overall growth in wealth management industry in India. As we discussed earlier, India is still underpenetrated in terms of professionally managed wealth. So as more wealth shift from unorganized to organized platform, companies like Nuvama automatically benefit from this structural trend. Now, this is a very interesting slide that compares India versus US wealth to GDP, share of financial wealth, and professionally managed wealth. India is much below US on every parameter. That creates a big opportunity. And wealth under management is expected to triple in next 5 years. This growth is clearly visible in companies' financials since listing. In last 5-6 years, companies' revenue have grown nearly 6 times and profits have jumped 3.5 times. Especially this growth was even higher between 2023 to 25 due to bull run. Although in trailing 12 months, the growth has reduced due to slowdown in capital market. Having said this, the structural growth is still intact. So growth visibility looks strong, but the real question is, does the market already priced in all this? Or is there still a gap between perception and reality? Let's have a look. So today Nuvama Wealth is trading at a PE of roughly around 23-24. Now for a company whose earnings have grown 3 times in last 3 years, isn't it a cheap valuation? So the answer is yes and no. First of all, we need to understand that while 50% around of Nuvama earning is from wealth management, which is a much stickier and stable business, even today around 20-25 earnings still come from capital market, which is volatile and linked to market performance. So capital market segment would never command a higher PE multiple. That said, around 75% of companies' business today has stable earning visibility. And of course, the growth potential is very high. Interestingly, if you look at its peers, 361 is a direct competitor, and today it commands a PE of more than 35. The reason why it commands a higher P multiple is because it's a pure play wealth and asset management company with a much higher share of recurring fee-based income. So 361 will always command a premium valuation. But going forward, if Nuvama is able to increase its share of fee-based income, scale asset management business, and reduce dependence on cyclical capital market, then over time, the quality of earnings would improve. And when that happens, Nuvama will see valuation re-rating. Even today, after nearly 18 months of price consolidation, companies' valuations are already looking quite reasonable at PE of 24-25. Now, before closing this video, let's look at the final part, that is key risk in growth thesis. So the first risk is dependence on market cycle. Today, around 20-25% of Nuvama's business is directly linked to market activity. So when markets are strong, revenues grow sharply. But during correction or low activity period, this segment can slow down significantly. Even in wealth management, since fees are linked to AUM, a sharp fall in market can impact earning in the short term. Second is the quality of revenue mix. As we discussed earlier, Nuvama is still in the process of shifting towards a more fee-based recurring model. Until that transition is complete, a part of the business will remain linked to transaction-driven income, which is less predictable. Now coming to the most discussed concern, that is promoter pledging. So promoter pledging basically means the promoter of a company use their shares as collateral to borrow money. So instead of selling their shares in the market, they go to the lender, that could be a bank or NBFC, and say, I own X% in this company, I'll pledge some of these shares and in return give me a loan. Usually this loan is taken for business expansion or to repay the existing debt. Sometimes they also pledge to fund other business within the same business group. Now usually promoter pledging is not considered a good sign because in case the company's stock price falls below a certain limit, lenders would ask for more collateral. And if company promoter cannot provide the collateral, the lender can sell those pledged shares in the market. And this can result in further sharp correction. In case of Nuvama, 62.8% of promoter holding is pledged. Now the reason behind this pledging is completely different. So Nuvama Wealth is majorly owned by PAG, which is a large Asia-focused private equity firm. PAG acquired its stake from Edelweiss Group in 2021. Now, private equity deals are typically structured using leverage. In simple terms, they use a mix of equity and debt to acquire business. And pledging share is a common way to provide collateral for that financing. So yes, for a typical company, high pledging is a red flag. But in this case, the context is different. It's more of a structural financial decision by a large private equity investor rather than a sign of stress in the underlying business. Also, you would see that Nuvama has high debt to equity. Again, usually debt to equity above 1 is considered a red flag. But remember that financial companies always have high debt because their business model is to borrow money and lend it further. In case of Nuvama, it also has a lending arm that provides loan against shares. Nuvama borrow money from banks or via commercial papers to lend it to HNI and ultra HNI clients. These clients use the fund for margin trading or loan against shares. Here, please note that the loan given are backed by liquid collateral, which is stock. So this is considered a low-risk lending. Also, Nuvama has more than 1,000 institutional clients within the asset service business where it requires money to meet the daily operational requirement. Hence, it has higher debt level. Again, nothing to worry about it. So if you step back and look at the overall picture, Nuvama Wealth Management sits at a very interesting position. On one side, the opportunity is massive. Wealth in India is growing, financialization is increasing, and more money is moving towards structured products and professional management. And companies operating in this space have a long runway ahead. Nuvama is clearly participating in this trend. The wealth management business is scaling well, AUM is growing, and there's a visible shift towards more recurring fee-based income. But at the same time, this is not a perfect story yet. A part of the business is still linked to capital market, which makes earnings slightly volatile. The transition towards a cleaner, more predictable revenue is still in progress. And then there are factors like promoter pledging, which even with the right context can create some uncertainty from market perspective. So considering both pros and cons at current PE of less than 25, Nuvama for me looks quite reasonable for long-term investment. So that's it from my side. I would love to know your thoughts on Nuvama. And if you find this video useful, do share it within your circle. I'll see you next video. Till then, take care.